What's next for markets?
Hi, this is Emily Needell, and today I am thrilled to be joined by Amy McAneny, partner and private equity tax leader at PwC. She's one of the go-to experts in the tax world and also a good friend of mine. Amy, over the last year, you've had to skip more than a few social gatherings thanks to that one big, beautiful bill and the demands it's been creating for your clients. For those of us who aren't tax people, what is this bill and why should investors care?
Well, Emily, first, thank you so much for having me on your podcast today. I'm thrilled that we're finally getting to do this and that we get to talk about such an exciting topic as the One Big Beautiful Bill. Today, you might also hear me refer to it as OBBB or OB3, but the One Big Beautiful Bill is basically a big refresh of the tax rules that businesses and individuals have been living with for a while. So to break it down a bit, at the individual level, the bill made permanent the 37% top individual tax rate. It also increased the standard deductions at the various individual income levels with a top deduction of $31,500 for married filing joint. The SALT cap was something that was also fiercely debated and a really big topic in getting this bill done. And there was good news there for individuals in that it moved from a $10,000 cap to a $40,000 cap, which means to the extent that you have state taxes, either income taxes or property taxes, instead of being limited at $10,000, you can now deduct up to $40,000. But only for families making $500,000 or less. So ultimately for individuals, some of these changes means that they'll have more cash in their pocket to go out and spend. There's much more news at the company level. What's important to know at the US corporate level is that OB3 changes a few rules of the game for how companies deduct expenses and how investment income flows through to funds, which I'll get much more into as we go through the podcast. But it doesn't really shake the foundation of how investors are taxed on returns from their investments in US businesses. The long-term capital gains rates stay the same. Qualified dividends rates stay the same, both at preferential rates of 20% plus 3.8% net investment income tax, so a top rate potentially of 23.8%. And ordinary income rates also stay the same with 37% at the top ordinary income rate. So the OB3 wasn't really a tear down and rebuild it moment. It was more like a tune-up and extension of some of the provisions that we've come to know.
Now, it sounds like most of these are pretty much all positive changes. Would you agree with that as far as the changes that have been made being encouraging for future growth in the economy?
Definitely. Certainly one of the big focuses was future growth of the US economy. And so for investors invested specifically in US businesses, it's really a net positive.
Awesome. So let's dive into institutional investors, talking about pensions, sovereign funds, endowments. What does OB3 really mean for those groups?
Sure. So institutional investors are really interesting because they're usually tax exempt, meaning they don't pay tax on the income that they earn from investments. But the companies that they invest in where they get their returns are not tax exempt. So the bill matters to them through the lens of what happens at the US corporate level and through the fund structures that they invest in and the impact of OB3 there. So as far as the impact for US companies, OB3 was really good news overall. OB3 had some important updates that really help in US-based businesses, and I'm going to focus on US-based businesses here. So first, US-based companies can now immediately deduct US or domestic research and development spending again. So these are costs that are incidental to product development and innovation. These used to have to be amortized over 5 years for U.S. companies or 15 years for foreign investment, and now they can be immediately deductible. So think about if you did R&D in 2024, you spent $1 million, you were only able to actually deduct 20% of that. Now you can deduct 100% of that. So you get the entire $1 million deduction, which would reduce your effective tax rate quite considerably if you spent a lot of money there. Second, there were enhanced depreciation deductions. So 100% bonus depreciation is back for assets that are placed in service in 2025. So again, that means if a company were to spend $1 million on machinery or equipment, they would be able to deduct that $1 million immediately in 2025. Again, that reduces taxable income, which increases cash. And then finally, interest deductibility is more generous now because taxable income is measured on an EBITDA figure when you're thinking about interest deductibility limitations. So although interest deductibility still is subject to a cap for U.S. companies, this approach provides greater ability for U.S.-based companies that are funded with debt or have a lot of debt on their balance sheet to deduct the interest related to that debt. So again, higher interest deductibility reduces taxable income, which reduces cash that's paid. So really, for U.S.-based companies, this means a much stronger after-tax cash flow, and stronger cash flow supports debt repayment, investment and growth, and more stable distributions to investors. So anything that relies on operating company performance will be affected in a positive way from some of these changes. And that should be money that investors see in ways of returns and after-tax distributions.
Quick question, just to jump in here for a second. So it sounds like a lot of what you're talking about in terms of being able to, the depreciation being this year, seems like it's going to be sort of an event. There's going to be a big benefit this year, and then after that, it's going to be less so because it's a one-time change. Would you agree with that as far as the positives?
I agree with the positive, but bonus depreciation extends out. So it allows you in 2025 for assets placed in service for you to get that 100% benefit. Same thing with 2026 and moving forward, it was extended. So that is a huge benefit because previously what was happening was that companies would invest $1 million in CapEx spending or improvements in 1 year, but they wouldn't get the benefit of all that spend in that year. It would have to get deducted over time. Now it's just an immediate deduction. So it is a net positive for 2025 and going forward. So it's not just relegated to 2025, it's on future spending as well.
And I imagine that it may be more incentivizing for companies to spend knowing that they can deduct it immediately, even going forward. So that all sounds really positive.
That's absolutely correct. And that was the goal here, was to get more money into the economy for U.S. businesses. So spending on manufacturing, construction, you name it, right? And being able to get that immediate deductibility means that these companies will spend more. One other thing I wanted to mention, Emily, which was fiercely debated in the tax community and would have impacted foreign investment into the U.S., which a lot of U.S. businesses really rely on that capital coming in to the U.S. from foreign investors, specifically foreign governments, foreign pension funds, there was an introduction of this concept of IRC Section 899, which would have been a new code section. And what this would have done was it would have made it so that foreign investment into the U.S., which was previously untaxed or taxed at lower rates, would have been now taxed. And what OB3 was trying to get at with this provision, which, by the way, was not enacted because it was very controversial and would have potentially curbed foreign investment, was unfair foreign taxes. So there was this idea that the US was being unfairly taxed in Europe, in Asia, and some of these other areas. And so this was a tax that was proposed on countries where the US government thought there were unfair foreign tax regimes. And it would have increased the amount of tax that foreign investors paid by investing into the US. This was ultimately off the table. It would have had a huge impact on markets, it would have had a huge impact on the private equity, private credit communities, which see a lot of inflows from foreign investors. But ultimately, because this was controversial, it was taken out of OB3 in its final stages. However, this is something that the tax community is really watching because it could have the potential to come back. And so we are monitoring this, but this was amazing news for U.S. companies and U.S. businesses, that we can still see that foreign inflow of capital, and those investors would not be taxed on the returns from that.
Wow, awesome. Okay, so it sounds like there's a lot of moving parts to what's going on with the new tax codes. Bottom line, how should institutional investors be thinking about OB3?
So they should be thinking about it in a very positive way, especially if they are highly invested in U.S. companies. These U.S. companies should be paying lower taxes, which means potentially higher rates of return. So it really was just a net positive for investment into the U.S. overall.
Wonderful. That's definitely good news for all the clients out there. Let's now shift to retail investors, high net worth individuals, accredited investors, people coming in through feeder funds or wealth platforms. What's the OBB headline for those folks?
So the headline here, Emily, is pretty comforting. OB3 preserves the core tax benefits of long-term investing for retail investors and individuals. These groups of investors, in my experience, right, care about two things. So first, how does this impact the taxes that I pay on my investment earnings? And second, will this change the way I think about investing in various products or industries? And so the good news is long-term capital gains rates stay the same. Qualified dividends rates stay the same. And qualified dividends are dividends that mainly satisfy very specific requirements, but most U.S. companies that pay dividends are expected to meet. So you get taxed at preferential rates there. And finally, there's more favorable treatment for investors that are invested in qualified small business stock. And so all of that is just a real net positive. One of the things I also want to mention is that for retail investors as well as institutional investors, these better business tax rules that I mentioned mean steadier performance and more predictable, hopefully, returns. So because companies can write off research and development more quickly, because they can take advantage of more tax credits and incentives, because they can write off large purchases through depreciation and finally deduct more interest, there's just a more predictable cash flow. And retail investors, when we talk to them about where they can expect to see this benefit, we think of it in terms of what industries are most impacted. So any investment in technology and software, you can expect to see increase after-tax returns through research and development deductions and credits that are now available through OB3. With heavy manufacturing businesses in the U.S., they're going to be able to take advantage of research and development as well as depreciation. Energy and utilities businesses get tax incentives through OB3. Healthcare and pharma, same thing, research and development credits. And then financial services firms, we can expect enhanced interest deductibility. So for retail investors invested in these industries, they can expect to see hopefully net positive returns. And when these portfolio companies perform better, the entire portfolio would be expected to perform better. The other thing I might mention is we know retail investors likely have some exposure to global investment. OB3 settled down some of the international tax rules. I won't get into the nitty-gritty there because it's very complicated, but retail investors that are invested in global diversification products, international private credit or private equity or registered alts products may see fewer tax-related wrinkles, unexpected adjustments, and there's just more predictability on the international tax front there in terms of how these companies are going to be taxed in the US on their earnings. So that's a net positive also for investors. And then finally, for retail investors, tax reporting might shift slightly in timing due to the impact of these changes. So companies are really working through right now how they implement a lot of these changes into their tax reporting for this year, given the changes to R&D amortization and depreciation. Those can be big changes to companies in terms of how they report out their earnings. And so they're working through that now. So there might be some time lag that we're seeing in terms of information for this year.
Amy, it sounds to me like what you're saying is that there's going to be more consistency for retail investors. Things should have fewer wrinkles going forward. And so basically, I believe that what you're saying is that retail investors don't need to rethink everything that they're doing here in terms of what they're investing in. Would you say that's an accurate statement, that these tax changes aren't really changing the game as far as what retail investors should be doing here?
I completely agree. It's funny, when this came out, all of our individual clients were asking us, what changed? What changed? And we're like, headline, not a lot, right? Like all the rates pretty much stayed the same for capital gains and dividends, and even for fund managers. So the individual owners of private equity firms and private credit firms, tax carry was not touched. So carry is the benefit of long-term capital gains rates that owners of private equity firms get for their performance. And so the headline on individuals is really like pretty much good news. As I mentioned before, the biggest thing that we were concerned about was the state and local tax cap, and that improved, although it won't improve for the ultra wealthy, but it will improve for the regular potential retail investor. So not a lot has changed there. As tax people, we're always trying to like pull out like what are the really impactful changes. Really, for US based businesses, there were a lot of meaningful, great changes, but for individuals, it's kind of business as usual.
Okay, I have a question for you, Amy. Since you missed so many of our weekly tennis sessions, I gotta ask, I feel like I deserve to know, over the last year, when you've been missing so many of our sessions for work, what is it that you've been doing? Have you been understanding the new tax codes? Have you been working through with clients to help them understand it? Has it, I mean, it sounds like for a lot of things, not everything has changed. Things have been made simpler. So
Yeah.
what is it that's been taking so much of your time up over the last year as far as what you've been doing with the new codes?
So really the focus, because I do focus on private equity and private credit, is what is the impact to the businesses, US based businesses that are owned, right, by these funds. And so that goes for the entire sort of stock market, right, which is made up of private and public companies, right? And you know, globally, but specifically in the US. So what are the impact of these changes? We've had to focus a lot on recalculating taxable income because of changes to R&D, changes to interest deductibility, changes to depreciation. All this is positive, but we've wanted to, in some instances, we're able to get refunds now for tax that was potentially overpaid before these rules came into play. So we've really been focused with companies on modeling out the impact of these changes, how it changes taxes that are paid both at the federal and state and local and international levels, and then what that means for valuations of businesses and ultimately for investors. So a lot of modeling has happened, actually. And one thing I should mention is that while these changes are very impactful at the federal level, each state makes a determination on whether they want to conform or not. So to just give an example of that, just because we can deduct 100% bonus depreciation at the federal level, a lot of states do not conform to this. So if you are a multi-state corporation or a corporation that has business in many different state jurisdictions, you have to make adjustments to your state taxable income for the rules of that state. And so that is where we've spent the most time, is really thinking through what did these new changes mean for taxation at both the federal and state and local level for US-based companies, and then how does that impact their valuation, the returns that they're giving to investors. So that's where we spend so much of our time, Emily.
Wow, there are a lot of layers to this, clearly.
Yes.
So I guess let's just conclude this with, I want to ask you, for everyone, for institutional and retail investors, if you had to say what the biggest takeaways of OB3 would be, can you just summarize what those would be for us here?
Sure. And this is not groundbreaking, right? It just provides a much more predictable tax landscape. For individual investors, there's good news in that the top rate is staying at 37%. We're able to preserve capital gains rates for long-term capital gains and qualified dividends. And we got that increased state and local tax deduction. So all great news for US investors. For US companies, again, just really meaningful changes around current deductibility, which allows companies to spend more because they're paying less taxes. And this will put more money, hopefully, into the economy. And we should be able to see that in year-end results. But if I was an investor, I'd really be thinking about what are the businesses that are impacted most by these changes. So I think I mentioned US-based manufacturing businesses, capital-intensive businesses. They're going to get the biggest current benefit through reduced taxable income. And then how do I think about where I'm investing based on these rules? But really helpful for US businesses, really US business friendly, really investor friendly as well, because it really didn't change any of the headline tax rates in a bad way, only in a net positive way.
This all sounds very good. Amy, I have to say thank you so much for joining us today. We're so grateful to have you here. This has been extremely insightful, and we really appreciate your time. I can't say thank you enough.
No, I'm really happy that we finally got to do this, Emily. I know we've been talking about getting together to talk tax for a while, and hopefully, we'll get the tax community will get a bit of a reprieve in 2026.
I've got my fingers crossed for you, Amy. Awesome.
Well, thank you, Emily.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.